Hi, this is Todd Baker, your certified mortgage planner. Today, I want to talk to you about and give you some great information about understanding the various loan programs that are out there when we're talking about residential mortgage loans. And so, right now, there are basically 5 different loan programs. And I'm going to give you a quick overview of each of them so you understand sort of where you may fit and understand why, if you're working with me, I might be recommending a certain one of them for you. All right, so first of all, we have conventional. A conventional loan is a Fannie Mae or Freddie Mac loan. So when you hear conventional, that's what we're referring to. The features of them are the maximum loan amount is $417,000. The minimum credit score is 620. You can go down as little as 3% down. If it's less than 20% down, there's going to be what's called private mortgage insurance or PMI. And what that does is it's an insurance policy to protect the lender in case of default. And that's what allows you to borrow more. There's a lot of people that think it's a bad thing. It's not necessarily a bad thing. It's all sort of relative. If you can leverage your money, buy a piece of real estate, and MI helps you get there, it's actually a good thing. There are some features about that. On a conventional loan, MI does go away automatically when your loan amount reaches 78% of your original purchase price, so long as you paid it on time. And then it's a credit score driven loan. So for Fannie Mae, Freddie Mac, they have what's called loan level price adjustments. And so there's a lot that goes into pricing and the interest rate and also the MI as well. The MI is handled by third party companies, but they base their pricing and their rates on credit score and loan to value. So for example, if you're a 620 credit score and putting a very small payment down, your credit score is going to be much higher, your MI premium is going to be much higher. In fact, it would be better to go to an FHA loan in that case. So it is a credit driven score. So a lot of times this is good for a second home purchase or your second purchase in life. A lot of first time home buyers are better with FHA depending on where you're at. But if you have 10% down, it's almost always better to go conventional. Typically, 680 or above, and with a little bit of a down payment, conventional is the best product for you. It does have a debt ratio capped at 45% overall debt ratio. So there are cases where you might fit the credit profile, yet your debt ratio is high for whatever reason, where you go FHA. Next is FHA. This is a government loan. In fact, these next three are government loans. But FHA, key features are there is a loan limit. And it's based on county, but most northern counties in North Texas anyways, it's 334, 650. That's the maximum loan amount. The credit score, I put 600 with an asterisk. Technically, FHA doesn't have a minimum score, but the secondary market, which is us and all the other banks that actually originate and fund FHA loans, usually most banks are capped at 620. We'll go as low as 600. There are certain cases we can go to 580, but you figure 600 or above, typically you can go FHA. It's 3.5%, and that's considered a minimum contribution. So it's a down payment, but the guidelines read minimum contribution because it can come from a gift from a family member. There is a mortgage insurance. It's the same idea as PMI, but it's called MI. And there is an upfront mortgage insurance. Right now, the upfront premium is 1.75%, and that gets added onto your loan amount. So one thing is, if you had like a 5% down conventional loan versus a 3.5% down FHA loan, that upfront gets added on to the base loan amount. So your net equity here is 5% going in. On an FHA, it's typically after you add back that 1.75%, your equity in the property is usually less than 2%. So that's an advantage for conventional if you're like we're weighing it. FHA also has a monthly MI premium, and typically, if you put less than 10% down right now, that goes for the life of the loan. If you put 10% down, it cancels after 11 years. Now, some of the key features with FHA, if you have lower scores, the rates tend to be a little bit better than conventional because it's less credit score driven. The debt ratios can go in many instances up to almost 57%. 56.9 is usually what it caps out at. And it's easier to credit qualify. So it's a more liberal program. It's more forgiving on credit. Significant derogatory events like foreclosure, the time frames are lower to wait. So it's an easier qualifying loan. Next, this applies if you are a veteran or the surviving spouse of a veteran. VA loan, big advantage is 100% financing. Okay, go up to 417. Now there's some caveats. You can actually go over 417, but the veteran has to contribute a certain portion towards basically there is a little bit of a down payment if you go over 417, but you still can get it. And even if you're a vet and you go with a VA jumbo loan, it's a great product. 620 minimal score. There's no MI, which is another key feature, so your payment's going to be lower, but there is an upfront VA funding fee. If you have a VA-related disability, quite often your funding fee exempt, and we would confirm that, and then you don't have to pay that. If it's the first time use, right now it's 2.15%. That's a pretty heavy fee. If you're buying a $400,000 house, you're talking to be like $9,000. If it's subsequent use, meaning the second or any time after the first time, it's 3.3%, and so it's a pretty heavy fee. However, it gets financed. So you can end up with buying a $400,000 house and having a starting loan balance of say $410,000 on a VA loan. The credit is fairly easy to qualify. Significant derogatories are shorter. So it is I love VA program. It's a fantastic program if you're a vet or a surviving spouse. Next is USDA. This is a rural-based program, and it's based primarily on income. In fact, going over credit, it's a 620 minimum score, but they have really tightened their credit down. So if your score is under 680, you really have to have low ratios and pretty clean credit to qualify. Otherwise, what it does is the system gives a finding, what's called a refer finding, and then you have to have a 680 to do what's called a manually underwritten loan. So that's some sort of insider baseball there. It probably sounds Chinese to you, but at the end of the day, if you're 620 to 680, you need to have pretty strong credit. It's zero down. There is an upfront guarantee fee, and then they do have a monthly fee. The monthly fee is less than FHA's, so if we're comparing the two, you can get 100% financing and no monthly fee. The big thing is there's certain income restrictions based on household size, and those get plugged in, and there's all sort of variants that get plugged in, and then we determine can you or can you not qualify. And then if you're income qualified, there's also geographical restrictions. It's usually an area that has 10,000 or less in population. But if you're a USDA client, I give you the tool where we can look and you can plug in an address and it'll tell you, is it in an area that's eligible or not. There are in the Metroplex plenty of places around all the outskirts. Like I'm in Prosper, it's still USDA qualified, even though we have more than 10,000 people there. And then last, let me back up. On the USDA and VA, one big misnomer, and even with FHA and conventional and all these might be down payment, zero down payment, but you still have closing costs. Now, I'm not going to go deep into that in this discussion, but you do still have closing costs. So there could be some out of pocket, it could be paid by the seller, they could be sometimes financed partially into the loan, but there are some closing costs. Last is jumbo. Jumbo is anything over 417. And it's usually, not always, but most jumbo programs require a higher score of 720, 20% down. There are a few out there that will go to 90 or 10% down, but by and large, they're all 20% down. 43% total debt ratio, so more restrictive on its debt ratio, and they usually want to see lots of reserves. So these are people that are getting into 500, 600, 700, 800 million, $2 million purchases, and much stricter guidelines. Usually what I do, if you're looking to do like a $500,000 purchase or $600,000 purchase, we'll do a first loan using a conventional loan, and then we'll refer you out to one of our credit unions and other local banks we work with to do seconds, to do a second loan, and then you have usually an easier qualifying situation than you would strictly go in jumbo. So this gives you an overview of what you're looking at for residential finance. If you know anything about your situation, you can sort of figure out sort of which bucket you could fit into. To tell you the truth, most people are going to fit into these two buckets right here. If you're not a veteran and you're not looking at a rural area, you're going to end up with conventional or FHA. And then it comes down to typically 680 or above with low debt ratio, go conventional. 680 or below or high debt ratio, you end up with FHA. Both are great programs. Neither one is better than the other. It's all relative to your situation and what would work best for your financial plan. So I hope you found these helpful, and I hope you have a great day.